Thanks everyone for joining. My name is Rishi Shah, and I'm Director of Product Management here at YCharts. Today, we are really excited to have a star-studded cast for you for our webinar with Shannon Saccocia joining us, as well as Caleb Silver. Shannon is a Chief Investment Officer at SVB Private. She holds the Chartered Financial Analyst designation, is a certified investment management analyst professional, and is a frequent contributor in CNBC's Power Lunch, Closing Bell, Nightly Business Report, and Halftime Report. Shannon, thanks for joining us.
Thanks for having me.
We also have Caleb Silver on the call today. Caleb is the editor-in-chief of Investopedia and the host of the Investopedia Express, as well as the Green Investor podcast. Caleb is also frequently featured on NBC, MSNBC, CNBC, and ABC Radio, in addition to his market commentary and his daily newsletters for Investopedia. Caleb, thanks again for joining us as well.
Delighted to be here. Thanks so much for having us.
Awesome. Well, before I hand it off to both of you, I did want to mention a few housekeeping items for us today. So a recording of this webinar will be sent to everyone tomorrow and will also be available on our YCharts YouTube channel. So be sure to like and subscribe when you're watching that on YouTube. We have a lot of great content there that we release sporadically. So feel free to do that. In addition, there is a Q&A section at the bottom of your Zoom screen. So feel free to throw in questions. We are going to have a Q&A at the end of the webinar. So it'd be great if you want to ask anything to Shannon or Caleb, and we can get to those towards the end. Also, a unique part of today's webinar is we're going to start off by talking about 2022 and beyond and the macro outlook there and go through some great charts. But we're also going to spend some time tackling some of those tough client questions that you might be getting as an advisor. So please feel free to throw those questions in the Q&A as well, and Caleb and Shannon will be able to answer those too. Lastly, before I pass things off, please keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts, Investopedia, or SVB Private acting as an advising party regarding client funds in any way. And with that, I'm going to pass it off to Shannon and Caleb.
Thanks so much, Rishi. We are delighted. Investopedia is delighted to be part of this. We are delighted to be partners with YCharts. We use the charts in our newsletters. We use the charts in our articles. Not only do they have great charts, they have great merch. Check out this pullover right here, inside, outside. Really good stuff. I'm a big fan of the company and such a great support team. And I know, Shannon, you're a big fan of YCharts as well. So good to be speaking with you. I'm such a big fan, Shannon. Watch you on CNBC all the time, read your commentary. And you know what? You love helping make people smart. So I'm looking forward to this session.
Me too. I'm excited.
All right, let's dive through. We're gonna blaze through a lot of 2022, but let's just set the table. Rishi, you're gonna drive, but I'm gonna call them out. So let's hit the next slide and let's get to some of this stuff right away. We want to sort of set the table on where we are, and of course, this is the big tug of war, Shannon, going on right now. The Fed funds rate versus inflation. Fed's going to keep raising rates until inflation comes down meaningfully. We heard Chair Powell say it again yesterday. We should expect to hear it again next week. But this is the big tug of war. Give us what you see when we look at these two things pulling against each other.
Yeah, the drumbeat of inflation just will not die. And I think coming into 2022, we all anticipated this inflation, right? I think we knew that the Fed, their idea about this being transitory only was debunked pretty soundly in 2021, and now coming into 2022, we expected this to be, really the biggest challenge. I think a lot of the emphasis was on the higher cost of capital, the pressure to earnings, the pressure to margin with these higher costs. But I think what has been a bigger challenge is that the credibility of the Fed has come into question with that transitory call, but also with the pace that they've had to execute these Fed rate hikes at. I mean, if you look at this chart and you just think about what we've seen historically in the last Fed hiking cycles, the pace, the velocity of the action that they've had to take is really what is phenomenal and quote unquote unprecedented. We've used that term a lot in the last decade or so, and it always seems like everything is without precedent these days. But I mean, I think the other thing to think about here is that inflation has two sides to it. And I think one of the things that we need to just keep in mind is that, in as much as we have shown that all of the inflation that we've experienced this year is truly not necessarily transitory, portions of it are. And I think that's going to set the stage for a lot of the conversation over the next 12 months or so, and why the Fed is so committed to telling us they're committed, because people are starting to see that some parts of these inflation numbers do feel a little bit transitory, and they want to make sure that all of us as investors are keeping our eye on the ball and really firmly believing that they're going to get to those yields that they've talked about.
Yeah, great call. And then mind the gap here at the edge of the chart here. You see this gap between where Fed funds rate are today and where inflation is today, 7.7% ish. We got a new reading on PCE this morning, but the Fed wants inflation closer to 2%. And we're a far away from that. And the terminal rate everyone's talking about in terms of where the Fed might finish raising interest rates is maybe north of 5%, closer to 6%. Big gap there, right, Shannon?
Huge gap. I mean, and you think about what the terminal rate historically has, you think about terminal rate, what does that mean? That's growth, right? That's expected GDP growth. I mean, inflation should be similar to GDP growth, and that's where the Fed wants to keep rates. And that's where that terminal number comes in. So you're sort of thinking to yourself, well, that implies that the Fed, would be looking for the economy to be growing at that pace, but that's not really what we're seeing either.
Yeah, not at all. Rushi, let's go to the next slide, because this is the other part of the problem, which is money supply versus inflation. Government was handing out trillions of dollars during the pandemic for good reasons, but kept doing that, swelling the balance sheet. The Fed was a buyer, right, of mortgage-backed securities and government securities. Now it's a seller, and it's trying to wind down its balance sheet while it's trying to wind down inflation, while it's raising rates. That's a lot of push-pull going on right there. What are you looking at?
The lever here is clearly trying to roll off some of this balance sheet. And I think it's, and you remember this, Caleb, I'm sure, we were coming out of the financial crisis. And because of what at the time was this, unprecedented quantitative easing, there was this expectation that we were going to see runaway inflation. How many of us were being asked by clients about gold and, other inflation hedges during that period? And we really didn't see it because we didn't have this other side, this fiscal stimulus side, this, significant influx. And some would say that slowed the economic recovery in 2010, 2011. But it also was the big difference between what you see here on this graph in 2010, 2011, 2012, and what we've experienced in the last 2 years. The problem with this, too, is that it's sort of counter. The Fed knows it needs to bring the balance sheet down because they know the debt service burden is significant on the US government, but it also creates probably a ceiling on how high they can really go on rates. And so if inflation doesn't start to come down, they are going to start to bump up against what else can they do. And I think, unfortunately, what could happen if we start to see a lot of economic weakness, they could kind of take their foot off the gas as it relates to bringing this balance sheet down. And that's a problem. I mean, you look at the questions around Japan, right? They've got a demographic problem, they have a debt problem. And I would say that the US is sort of tiptoeing into that territory.
We're getting there. We're getting close.
So that's what you should be worried. I mean, this is, the government will pay its bills. And I think that as long as we get Washington to play ball with the debt ceiling, we'll be able to do that. But I do think that this is going to be a longer term concern, especially with some of the things that do have precedent when you have a high debt load and you have less than supportive demographics.
Yep, absolutely. Next slide, please, Rishi. Okay. What has this all meant for investors? Well, in the past year, it hasn't been very good at all, although we've been having a really nice recovery right now, especially in the Dow Industrials. But just look at the 60-40 portfolio. I know it is not the Bible that maybe it once was, but it's a good place to start to look at what a diversified investment portfolio could look like. One of the worst years in history, if not the worst year in history for the 60-40. Year's not over yet, but how do you make sense of this as an advisor trying to explain this to your clients?
Yeah, I mean, I think I honestly, I know we spend a lot of time and you and I both do talking about the equity market and what's happening in the equity market. Like, let's put that aside. The outlier here is the bond market. And that's really what happened with the 60-40 this year. And so this sort of unprecedented, there's a, if you plot the performance of the US ag, for instance, across like a 30-year time horizon, the outlier is so clearly this year, it's not even close in sort of a Monte Carlo type simulation. So you have to look at it in terms of what is the catalyst for the bond market to return or normalize as, part of your assessment of the 60-40, because you're going to continue to have equity volatility. That, it is a higher range of outcomes asset class. That's what happens. But I think the bond piece of this is really where people are pointing to the death of the 60-40. Diversification doesn't work. this is a scenario that we haven't experienced since the late 70s and early 80s in terms of inflation and rising rates at the same time. This is an anomaly. And so the 40 is really the anomaly here. And people should remember that as we look forward over the next 5 to 10 years.
Yeah, we do talk a lot about stocks. Stocks get all the attention. We talk about them on TV all the time. But as you know, bonds really run things around here. That's where the real money is. Let's look at that over a 5-year span, because it's been somewhat reliable, but you get the impulse for people, especially in a zero interest rate environment, to want to favor stocks. And that's what's been happening. But the last 5 years, it's treated you all right.
Well, and this is when we come back to time horizon, right? And this is where you talk about, I know we're going to tackle some tough questions from clients, but one of the biggest questions that we have for clients is how much liquidity do you need? And frankly, the environment for what does that liquidity yield for you, and what are the alternatives within that are much better today than they were 3 years ago. But I think that one of the challenges here is that for any meaningful time horizon, we know that equities have shown to be persistently higher. So there is an upward trend to that. And I think, again, the longer that you pull out these time horizons, you just got to make sure that that's married with your client's actual time horizon, rather than your drumbeat of you can just wait a little bit longer for this to play out.
Yeah, absolutely. It's got to fit into everybody's portfolio. It's got to fit into everybody's plan at the end of the day. Let's talk about housing, because when we're talking about the Fed raising rates and trying to bring down inflation, we're talking about demand destruction. And that is exactly what we have seen in the housing market since the beginning of this year, month after month. Lower existing housing sales, lower building permits, every metric you look at basically in housing, except for prices, which have been cracking lately, you're getting this drumbeat. You like to look inside the housing market at these metrics. What are you seeing here?
Well, I think we talk a lot about the lag, right? And if you listen to Powell's comments and you read the minutes from the last Fed meeting, everybody's waiting for the Fed to acknowledge that there's a lag, and there certainly is. But this is really where we've seen it first and foremost is in the housing market. Mortgage rates react very quickly, and buyer demand reacts very quickly. The refinancing is essentially off the table, which for a long time, there was a lot of activity from a mortgage perspective going on in refinancing, but it also created a platform for affordability. There was a foundation in the housing market that even though prices were moving higher, rates were so low that there was this affordability that doesn't exist today. And so my question that I get often is, okay, we are starting to see some pressure in pricing, which honestly, given a lot of the pull forward that we saw in 2020 and 2021 in terms of home buyers, that was not likely to continue at the same pace. But the other thing to look at is look at how much supply. Look at this purple line. And people are asking me, are we going to have a similar housing bust to what we experienced going into the GFC? Absolutely not, because the supply is not there. We have been under supplying the housing market ever since 2009 in the United States, especially from a single family perspective. And so the supply is not there. There will be kind of this structural ebb and flow over the course of the next year to year and a half as buyers adjust their expectations for mortgage rates, as that affordability is adjusted based on these higher interest rates, but they'll re-anchor to that. And housing likely does persist as a catalyst for some growth, not the amount of growth that we experienced in the last couple of years, but as a positive to GDP 5-10 years out, because we still have a demographic tailwind. 43% of millennials own a house, 65% of the general population owns a house, and that household formation comes later. So the housing market to us isn't quite dead yet, but we need to rectify, these prices need to come down a little bit more to increase affordability. And we also need to see some supply come back into the market. That probably happens over the next year and a half or so.
Yeah, these higher mortgage rates have pushed so many potential first-time or second-time home buyers out of the mortgage market into the renters market, which is why you saw rent prices increasing so much as a part of inflation. Those are backing off a little bit as well. What about housing, Shannon, as an investable sector, whether it's REITs or whether it's the builders themselves, especially looking into a potential recession 2023? Where do you think housing fits in terms of a portfolio, in terms of a client portfolio right now?
So home builders are challenging, right? Because I think what home builders, in sort of this post 2009 world is they look very much at, what is the profitability and the margin on each new home that I'm going to build, and they are more than willing in this environment to turn it on and turn it off, right? And so I think that from a home builder perspective, there's likely to be sort of continued pressure on that as we don't expect starts to pick up significantly over the course of the next year. So I think that home builders are probably a longer game, but I think you have to be very selective in terms of which ones that you want to be investing in. I think housing adjacent stocks have been hit pretty hard this year because they're adjacent to housing, and housing's been hit pretty hard. But if you think about what an entrenched consumer, what an entrenched homeowner does, is they improve their home, and they're likely to continue to improve those homes that they're in rather than going out and finding a new one in this environment. So I think housing adjacency is an interesting byproduct or an interesting subsector that you can look at here. And as it relates to REITs, I mean, Tax Cut and Jobs Act, REITs are a nice pass-through vehicle. And so for taxable investors, I mean, there's a benefit there. If you're in a REIT structure, particularly on the private side, really interesting environment for that. I think there's probably been a little bit of demand pull forward in that space, but I do think that longer term, the REIT structure maybe in a different interest rate environment becomes a little bit more attractive.
Let's take a deeper dive into some sectors with the next slide, looking at a lot of the sectors that have had some strength this year, and you can't deny the strength of energy. What a year for energy stocks, especially the oil and energy sector. Some of the top performing stocks, obviously ExxonMobil, Occidental, and a lot of these. Do you think we are in a secular bull market for commodities, especially the fossil fuel complex?
Well, I think it's relative to where we've been historically. I think that we go back to zero spot or sub-zero spot oil in the depths of the pandemic, right? I think that the interesting thing about the energy complex is that there's been so much emphasis on valuations in this last year, especially the re-rating of longer duration growth valuations, at much higher multiples than the market. Energy is the opposite of that, right? There's a lot of really cheap energy stocks out there. And with oil prices probably a bit range bound here, just because not only do we have, I would say we're seeing modest increases in demand, but that ebbs and flows. It's really a supply problem. There's an undersupply, particularly of oil and gas or of oil in the next couple of years. And so with that undersupply and the fact that OPEC Plus is continuing to potentially cut production, you just start to think of there's probably a floor there. I would say on the commodity side more broadly, I think that you could look at something like the reshoring of manufacturing here in the United States and global infrastructure build as being potentially a support for commodity prices. But I think energy stocks have continued to benefit just because of those valuations and the margin that they're able to throw off. And they have been, an outlier when compared with other sectors who've really been hurt by higher costs.
Yep. And we could see a lot of those right here. But then let's look at some of the quote unquote recession proof, or at least the defensive type sectors. You got to look at consumer staples, basically flat for the year, where we've seen the S&P 500 down 15%, as far down as 27%. Consumer staples, you would expect this type of behavior. What do you expect for 2023, given the behavior so far?
Yeah, I mean, this has been sort of textbook performance in consumer staples. You're concerned, you're looking for defensive places to hide out. The interesting thing about consumer staples as a whole is that they're actually starting to seem somewhat expensive. And if you think about the longer term higher cost profile that we're anticipating, consumer staples, those are fairly lean margins across the board. I mean, as a generalization, right? So I would say we're probably not as excited or optimistic about consumer staples performing really well in the first half of next year. If you do get a significant slowdown or contraction in economic activity, then I think you probably get some flooding back into this sector later next year. But I think we've pulled forward some of the performance here in consumer staples, and some of those stocks look a little expensive for low margin businesses.
Yeah, talk about textbook. Look at consumer discretionary with concerns about a recession, one of the worst performing sectors when we look at just the ETF performance, down 31.5% so far this year. And then there's tech, which high interest rates, rising rate environments, not a friend to growth stocks, especially the tech stocks that borrow a lot of money and need a lot of that cheap money for their expansion. Somewhat of a recovery here, but we're not going back to the old days, are we?
No, and I think that most importantly, when you think about technology, you want to make sure that you understand, where you're getting that exposure. And I think the challenge right now is that, in as much as the S&P 500 performance was was helped, coming into, the pre-pandemic world and then through the pandemic by the large concentration technology stocks. Obviously, that market weighted index has been hurt by that. I think that within technology, there's still going to be the need for disruption and innovation. That's a longer term trend, because in a higher cost environment, in a hiring constrained environment, in an environment where companies are trying to find any way possible to be able to increase margins, technology does that, right? That's why we've been in a deflationary environment for 20 years, is because it's been a combination of globalization and technology. So if you think about that, tech stocks aren't dead, but I think you really have to think about profitability, and you have to think about prioritization. Cheap money leads to poor capital allocation, and I think what you're seeing now is a right sizing in a lot of these big tech businesses in terms of what they're spending money on. And I actually think that it ends up creating stronger businesses 3 or 4 years from now, but it's going to be a little bit painful in the interim.
Got a great question from an attendee, and I think this is on everyone's mind, and this is kind of what we're circling in general, which is clients are often asking them, what are some good portfolios or holdings to withstand a recession? What's your answer at a time like now, looking at what may happen next year?
Yeah, I think if we truly go into a recession, then you can imagine that the Fed is going to have to at least, put a pause on being more restrictive, but likely to be at least incrementally more accommodative. And so there, that's where you sort of lead yourself back into the bond market. I think that just from a return perspective and a yield perspective, we've just re-rated, where we can sit and what we can get out of a fixed income portfolio. So it's always going to be a good place to be in a recessionary environment. And then thinking about sectors that, can continue to survive in a recessionary environment. Healthcare is a great example. We talked about consumer staples might be expensive, but certainly would be flocking to that. You really want to think about companies that have longer term cash flows, have contracts that are somewhat recession proof, and really focus your portfolio there. And then I would say just be open to kind of non-correlated recession, things that aren't as tied to secular tailwinds. And if there is a particular tailwind, such as infrastructure build, a lot of that spending is going to come anyway, even if we are moving into a recessionary environment. So that would be a great example. Some parts of the industrial sector, for instance, that could be really interesting in a recessionary environment. And that's a bit counterintuitive to what you've experienced previously.
Quality matters, strong balance sheet matters, good margins matter at a time like now, because those are going to get squeezed, as you can imagine, next year. So that's what I hear. And we hear a lot of people say, and I'm sure you get this all the time, it's a stock picker's market. It's not necessarily a throw a dart anywhere you want type of market. What's your take on that? Stock picking, index investing, ETFs, I guess it depends on who you're doing it for, but what's your overall vibe on whether it's a picker's market or not?
So I think that there are opportunities, particularly in an environment where you have a lot of management teams that are facing challenges that they haven't faced before. They're facing higher costs and wages. They're facing hiring issues. They're facing, maybe a little less constructive capital market environment. And so I think that's where in execution, because we've actually seen, quality underperform this year, and that's been somewhat surprising, but that probably doesn't persist in a more recessionary environment. So you think about quality management teams, you think about capital allocation, you think about shareholder return, not just, capital appreciation on the stock, but what's the return to the shareholder? I do think that's why dividends become more important in this next environment. And so I would say there are opportunities for stock picking, but I wouldn't be afraid to really, again, go back to sort of that thematic assessment of your portfolio. And if we're going back to a probably slower growth environment, akin to what we were in 2019, but with higher costs, where are the subsectors and industries that could potentially benefit from that? And so you can do that via ETFs fairly easily. I mean, there's a number of different vehicles that you can utilize to be able to get that type of exposure without having to go so deep into those individual countries or companies. And so that's an important aspect. A balance between, micro and macro, I think probably makes sense as we move forward in the next 2 to 3 years.
Yeah, great point. And folks, you can submit your questions in the Q&A, as Rishi said at the top. So feel free, we'll grab those as we go. Let's hit the next slide, because this is the thing we just can't avoid. Dollar versus the stock market, dollar versus any risk asset has been the story really in 2022. Dollars come off a little bit lately, and especially as the Fed is sort of talking a little bit more dovishly here. But as the dollar goes, so conversely do a lot of these risk assets, right?
Especially those that are larger, right? So you think about, cap here, and, it's not 100%. It's a generalization, but it's pretty accurate. The larger company you are, the more that you will likely have revenues that are generated outside of the United States. And so you have to think about the translation of those revenues. You also have to think about it in terms of, what is the strength of that dollar, and what's that tied to, and why has it been strong? And is it really just interest rates that are driving that, or is there a true risk on or risk off sentiment? And so that's why they tend to move in this fashion. And I think right now the challenge is that the Fed is likely to start to get closer to that pause. And we're going to see interest rates moving higher in other parts of the world, especially in Europe and the UK, given what they're facing from an inflation perspective. And so maybe the shine comes off the dollar just a touch going into next year, but we're still in a stronger dollar scenario. That currency translation is still going to be an issue, particularly for mega cap stocks that have significant international exposure. And so this dynamic is likely to persist for a little while, because we're at least not expecting significant dollar weakening next year, maybe just some stabilization.
Right. And strong dollar, people think, hey, that's a great thing. But when companies, especially half of the biggest companies in the country, are doing half of their business outside of the country, getting those dollars back, strong dollar is not so great for them. And it's really rough on emerging markets who have their debt priced in dollars and do a lot of exporting as well. So let's hit the next slide, because we got to look around the world here at what's been doing well so far this year and what the next year looks like. If we're going to go into a global recession, I think Europe and the UK, maybe the US, maybe some other countries, the strong dollar really hurts, but it's been an unusual year globally, hasn't it?
Absolutely. You look at this chart, and this, you and I were talking about this the other day when we're sure getting ready for this event, just look at Brazil. It's shocking, right? In terms of, the returns. But, I think the biggest challenge, concern, question has been China. I think if you look at how China has fared this year, I think it actually could have been much worse in terms of Chinese equities, just given the sharp fall off in economic activity, the insistence on maintaining zero COVID containment policies, the lack of both a recovery in production and consumption. You're just thinking about if China doesn't, and I guess my question is, if China doesn't participate on a go forward basis, that really brings down kind of global GDP as a whole, and how do you account for that, and how do you allocate to that? Because with an environment such as we're getting into, if you start to see dollar weakening, you should see some sentiment improvement for emerging markets. But with China such a big question right now, can you get that lift given the allocation to China in both active and passive vehicles?
Yeah, great question. And again, who had Brazil as one of the top performing global markets this year? I may have had them at the top of my World Cup pool.
Yeah.
But I definitely did not see this happening, especially with the election that they just had,
right.
Especially with inflation as rough as it is there. Rushi, question in the Q&A, probably for you, is the chart priced in US dollar, the prior chart, or in the local currency return? I'll let you handle that one. But let's look at some of these other markets. And the US has been the place to invest, Shannon, as you know, for the past decade, maybe 2 decades right now. And then looking forward into 2023, is it the cleanest dirty shirt, or is it going to be an outlier economy like a Brazil or a minerals and energy heavy economy that's going to outperform some of the other markets?
So I think there's two parts to that question, right? It's do you sort of put your eggs in the inflation basket and just really look at economic drivers of a particular economy and how tied those are. We talk a lot about divergence within the emerging markets, whether you're an energy importer or exporter, right? That has certainly played into the success or lack thereof in emerging markets over the course of the last 30 or 40 years. And so I think that one of the things that you want to think about is, why the US, right? Why the US or why not? And I think it's easier to say why the US, just from an economic perspective. I think the energy, relative energy independence that we're experiencing now, and that undersupply in energy and the cost burden on consumers for that is certainly a big question. And then you just think about it in terms of, if you're looking at a particular economy just because of the drivers of inflation, how much of that has already been experienced and how much of that has been priced in? And do we really think that I'm not going to sit here and belabor the when is the recession happening, question. I mean, I think it's a good one, but not in this like point. But if you think that we are going to see a slowdown in global economic growth, I don't think I'd want to be fully tied directly to kind of a commodity producer and something I would rather be in a more diversified economic environment and investing there.
Yeah, great point. All right, let's hit the Bitcoin slide because not that many people hold it. We know that some people have dabbled in it. Most portfolios are most portfolios are under $1,000 or around that range. That said, the ultimate risk asset, lots of inverse correlation with the dollar, but a lot of correlation with other risky assets. We've obviously had the FTX collapse and bankruptcy, some other cryptocurrency brokers also going out of business here. But how does it stack up? And do you get this question about where it fits into a portfolio? Can it be a smoother? Is it inflation resistant? What's your take?
So I'd say we get less questions today than we maybe did a year ago about this. And the questions that we get are becoming more nuanced and perhaps more informed. What if I do have this, like, how would you account for that in my portfolio? Like, how do you think about that? And does it say something about my risk tolerance, or is this really just trying to get early into what is still a very nascent, potential economic driver of 5, 10, 15 years from now? I think that the biggest challenge with Bitcoin is that there is and really any of the cryptocurrencies, is that there are a lot of people who believe in, the potential for blockchain disruption and innovation. And this is really the easiest the easiest way for the average investor to access that innovation and disruption. But I don't know that it's the best way. And so I think that when we talk with our clients and we talk to investors, or if I'm asked for my opinion on this, you assign it to be a significant risk in your portfolio. And so whatever you would, do in terms of like, this is how much risk I can allocate, this is how much value I can allocate to this, and expect that I am going to live with a significant amount of volatility, that's how you size this in your portfolio. And I just think that the experience of coming up and then managing that, right? Being able to sell that and being able to treat it like any other position in your portfolio and sell it when it's up and trim some of your gains, because that doesn't make you weak. That just makes you, a better decision maker in terms of how are you sizing this as part of your portfolio. Absolutely.
And then being able to expand the horizon and look at Bitcoin's past performance and volatility, so useful. And that's what's so useful about
Caleb, if you go back, I mean, where Bitcoin has come from and where it is today, I mean,
it's up about 350,000% in the past
right.
decade.
Yeah. So, I mean, it's not like people cannot have made money here. But it's more about treating it with the same sort of discipline that you do anything else in your portfolio. And when you have big gains, you got to trim the position, and you can only put as much as you feel comfortable putting at risk in this particular area.
Yeah, risk management, so important in general, but especially with some of these newer type quote unquote assets. We're going to get to some more attendee questions in a sec, but I want to ask you one just before we do that, which is, what is nobody talking about for 2023 that you think is really important? What is being missed here, or what's not getting enough attention from an investor and advisor perspective as we think about next year?
So I talked a little bit about China already, and I do continue to think about the uncertainty of policy and how much not only the uncertainty of policy is related to China kind of domestic policy, but we've spent the last 5 or 6 years talking a lot about our relationship with China foreign policy. How does China feel like it should fit within the global economy? I think we should be paying more attention to that. I think that is something that could crop up again as a very reasonable either concern or catalyst for 2023. The other thing that I would caution is that I think there is a continued expectation that the allocation to equities that we experienced in portfolios, or that we saw in portfolios in 2019, 2020, 2021, that is going to reemerge. And so that there always will be, constant flow into the equity market. And I would say that there's a lot of investors that we're talking to today that I wouldn't have pinned as being particularly conservative, that with yields where they are today, which are not astounding numbers from a historical perspective, but they're astounding to them with the backdrop of our previous environment, they're really comfortable clipping that coupon on a very
4 to
low
5% sounds great.
Yeah. And so, and the cost of their debt is below that, Caleb, right? That's there's a delta there that I think that people, and so I would see portfolios maybe not going completely conservative, but I do see people wanting to keep more of that money in conservative assets, clipping a coupon on that. And I think it's going to take a little bit longer before there's a significant amount of push and enthusiasm into the equity markets. I think people forget that, in an environment where you are seeing inflation even at 5 or 6%, that you want to make sure that you're keeping up from a principal perspective with that inflation. And I think people have forgotten that that's a drawback of the bond market, if you will. So I that's what I would watch for next year. I think there's always an assumption that as flows come out of the equity market, they're going to eventually all go back into the equity market because that's what we've experienced for the last decade. I think we could see some slippage there.
Yeah, great point. But that's the value of advice too, is when you're working with clients, is you want your money to, outpace inflation. There are alternatives. There are other ways to win this race.
Right.
And you don't have to get caught up in what used to work because the dynamics have changed so much. I know we have some more questions from attendees. Rushi, can you read the first one of those out for us, please?
Yeah, definitely. So the first one is about the job market. With all the news about jobs and wages, how can you explain the impact of inflation on wages or the job market in general? And how can we answer that question to clients if they're asking you that as an advisor?
Yeah, I'll take a stab at that, Caleb, and then you can add on. I think that we really haven't seen, certainly in the last 10 years, but probably closer to 20 years, really any meaningful wage growth here in the United States, either real or nominal. And, I think a lot of that has occurred and really hit the bottom line for many companies. But it's really important to think about wages tend to be very, very sticky. And so that's why I think that when you're thinking about margin improvement, when you're thinking about the bottom line and companies being able to grow their EPS, this is a part that you really need to kind of keep as a discount to that, because there isn't going to be much that they can do, even in a recession. If they cut jobs for many of these companies, they're still the wage plateau is still a lot higher than it was previously. So I think that, when you think about the employment market, the reason that the Fed is so concerned about the employment market still being strong is because they know that if it's 5% or 6% or even 3.5% or 4%, that inflation doesn't go away from wage growth. So I think that's one of those, we keep talking about, like, good news is bad news. Why does the market sell off when we get a good employment report? It's because the Fed knows that inflation is the furthest thing from transitory.
Right. Great point. And it's so rare to hear the Fed actually wanting to raise the unemployment level and put the jobs market in a tighter vice here. But that's exactly what they have to do, because once you raise those wages, you can't really bring them back down. It's very difficult to do that. At the same time, even though we've had that wage growth, that 5% or so this year, Shannon, you said it, it's not keeping up with inflation. Right. So it's very sticky high right there. Yeah. That's why it's so important. And you heard Fed Chair Powell say it this week. You'll hear it again next week. The labor market's a little too hot for their taste, but it's imbalanced because we still have about 1.7 jobs for every available worker. It's just a very peculiar labor market right now, but it is right at the tip of the spear right now in terms of where we go policy-wise. Next question, Rush.
Yeah, and I'll also open up YCharts for this one and try and create a quick chart. But the question is more about PPI and CPI, and what's the difference there? How would you explain the difference, and what are you keeping an eye on when you're looking at those two economic data sets?
Caleb, do you want to take that one, or?
Yeah, these are a few of our favorites. CPI, of course, the consumer price index. PPI, the producer price index. One measures, a basket of consumer goods that we spend money on every month. It's always a rear view mirror indicator, as is PPI. But there's two parts of the CPI that are important. There's the CPI, the headline number, and then there's the core number, which strips out the food and energy prices. Food and energy are a big part of inflation this year. So you strip them out, you're going to get a lower number. But the Fed likes to see that core number come down because gas, again, and food, they're subject to other factors. So we're looking at a core CPI, and that, as well as headline CPI, has been coming down. Producer prices, this is what producers are feeling, the input costs that producers are feeling, that they eventually have to pass on to consumers. So it's another good way of looking at the impacts of higher prices. Both have been sticky high. Producer prices a little stickier than consumer prices, and that's when we want to watch. And also PCE, the Personal Consumption Expenditures Index, that's the Fed preferred measure of inflation, measures a broader range of goods and services, but also it tracks it a little bit more frequently, so we don't have to look back a full month.
Yeah, I would just say, you know, an interesting way to think about it is that you're always going to see a peak in PPI before you see the peak in CPI. So just, you know, kind of understand that the more stops that there are between production and distribution, the more opportunities that producers have to raise those prices along the way. And so, you know, an impact of what we've seen from a global supply chain perspective is that a lot of those costs were borne at multiple points along the road, if you will, to the consumer. And so it's going to take, that lag is really probably the biggest lag that we feel is in the market right now, is in terms of the consumer really benefiting from that improvement at the producer side.
Great point. That's why a lot of people are so focused on a potential railroad strike here in the US. That could be a supply chain hiccup that could affect producer prices, which will affect consumer prices down the line here. So that's why that is front and center in the news. Rushi, any others?
I think that's all I have on my list. Were there any others that you would want to cover? If not, I think we can wrap up here.
I'm good. But Shannon, again, you are so full of common sense. Love watching you on TV and reading your notes. And folks, you should be following her if you're not already, but also follow YCharts. Such good insights coming out of the team at YCharts. And the tool is great. And so is the merchandise. So thank you so much, Shannon. A great pleasure speaking with you. And Rushi, thank you so much for your partnership and for including Investopedia in this.
Thank you so much.
Yeah, thank you. Thank you everyone for joining today. And thank you, Caleb and Shannon, for such a great presentation. I'll just wrap things up here. This was really engaging and we covered a lot. Just a reminder, a recording will be available so you can go back and look at some of those great charts we talked about and hear what Shannon and Caleb had to say about it. Also, if you're new to YCharts, feel free to go to YCharts.com, set up a free trial and talk to us, and we can get you set up using charts as great as Shannon and Caleb are as well. And with that, I will wrap things up and thank you everyone for joining. Have a great day.